Hi there, welcome back to another topic video. It's macroeconomics and it's linked to our study of the economic cycle. This time we're going to focus on shifts in aggregate demand. Now don't forget, in the exam students are often required to use an AD-AS diagram, and you might be specifically requested also to show and explain the impact of a shift in AD on real output, real GDP, and also the general price level. Here's a pretty up-to-date chart showing the UK economic cycle. The red line shows the level of GDP, clearly follows a cyclical pattern there. Recession in 2008 and then the recovery since. The blue bit shows the quarter-on-quarter growth of GDP, and save for the odd blip in 2011, then the British economy has been growing fairly sustained way for the last 5 or 6 years. Now, macroeconomic equilibrium is the starting point for our topic video today. Equilibrium in the short run is established when aggregate demand intersects with short run aggregate supply. Of course, equilibrium just means a state of rest or balance. There's no tendency to change. At the equilibrium output, in this case it's Y1, total planned demand for goods and services, aggregate demand, is close to the actual production, both from domestic and also of course from external sources. There could be some imports. So this is our equilibrium starting point. Here's an example of how aggregate demand shifts out from AD1 to AD2. It's important to get the explanations correct and precise, so an outward shift of AD will lead to an expansion along the aggregate supply curve in the short run, and that's going to lead to a higher equilibrium level of national output. Y1 moves to Y2, and also depending on the elasticity of the aggregate supply curve, it could lead to an increase in the general price level as well. So that's a shift in aggregate demand, and the phrase which is good to use in the exam is that a shift in demand, an outward increase in demand, will lead to a cyclical increase or a cyclical rise in output, and hopefully also an improvement in the labour market. A couple of factors that could have caused it, and there's obviously many factors that build into the aggregate demand function, but the housing market is oftentimes seen as an important source of demand for goods and services. This chart shows the annual rate of change in the average price level of UK property. House prices were falling in 2009, as you can see, in the sort of the recession period, and they dipped a little bit again in 2011. The economy was going through a fairly flat phase at the time, but since then, as you can see, since 2014, the annual rate of change of property prices hasn't fallen below 5%, and in some cases, of course, above 10%. So increasing house prices could have contributed to the outward shift in aggregate demand. We're going to be looking at the housing market in a separate topic video. Check that one out. Another key factor which could have caused an increase in aggregate demand might be an improvement in consumer confidence, or Keynesian animal spirits. This chart brings us up to speed on that. It's a survey of consumer confidence. It asks people to look forward and think what's going to happen to the economy, as well as their own personal economic circumstances. It's a volatile data series. We've had deep falls in consumer confidence in the early 1990s, the recession years, and then again in 28 to 29 as Britain fell into the last recession. It's quite interesting from this chart that overall consumer confidence in 2015 was significantly higher, and certainly as high as it was in the late 1990s. So that could have been a factor causing AD to increase. So consumption, if that goes up, household spending on goods and services, that's going to feed through to aggregate demand. It's going to be an outward shift of demand there. Increased investment will increase the demand for capital goods. Quite important. And crucially, I think the sort of key point there is that an increase in investment also increases aggregate demand for goods and services, as well as aggregate supply. The key evaluative question, I suppose, is will that rise in demand cause actual output to go up? Well, that of course depends on the elasticity of the aggregate supply curve. Let's think about a fall in AD an inward shift of aggregate demand. One approximate cause could be an increasing trade deficit. Quite an important point to take on board here, that when a country is running a trade deficit, the value of imports is greater than the value of exports. And as you can see from this chart, that's certainly the case for the UK. We ran a trade deficit of over £35 billion last year. And that could cause an inward shift of demand. How do you show this? Of course, well, you shift the aggregate demand curve to the left, 81 to 82, and that causes a contraction, movement down the short-run aggregate supply curve to a lower level of national income. And this will be the classic diagram you might use, for example, if you wanted to show a cyclical recession in an economy. It doesn't have to be the UK, it could be any country where the factors are bringing about a fall in AED. So we focused on shifts in aggregate demand. There'll be a separate topic video on shifts in short-term aggregate supply. Thanks for joining me on this one, and I hope to see you again soon on our channel.